Hey, I hope everybody's having a great day today. My name is Brent Moore. It's time for managing an options portfolio. And today I want to hit up implied volatility and talk about different implied volatility measures that are available to you and how to potentially use those. I also want to talk about, actually use practical examples as we do these, and we're going to manage some trades too, some existing trades there. And along for the ride is Mr. Cameron May helping me out today. I appreciate Cam. He's helping me out in the chat. And I encourage you to follow Cam on X and myself on X as well, at Brentmore CS, at Cameron May CS. He posted those X links in the chat there for those of you who are watching live. And if you're not watching live, that's okay too. We're glad to have you as well watching on the recording. Just a reminder before we get too far into this, though, that options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. And it's not a recommendation of any security, chart pattern, or investment strategy. Paper money application. That's what we're going to be using today, the Thinkorswim desktop software. That's for educational purposes only, and Schwab does not recommend the use of technical analysis as a sole means of investment research. All investing involves risk, including loss of principal. And past performance of any security or strategy does not guarantee future results or success. The paper money virtual trading application will not assign a short option position early. That's different than real life, where you may very well be assigned early on a short option. So you just need to be aware of that. I see some familiar names in the chat. Welcome to all of you. I'm not going to name names because we got a long list there, but glad to have you here. So let's head on over to the Thinkorswim platform. Market, this is the S&P 500 here. Up just a smidge under 2% today. So nice little bounce. You can see good or bad in the market right now. I mean, the general trend hasn't been great, but the shorter term trend, we have established this higher low. That's a nice thing. Intraday, we're down near the bottom of the trading day, but and we're also near some potential resistance areas. You can see the trend line I've drawn there. You can also see the 20-day moving average. Your forecast, your trend forecast, your support and resistance may influence what kinds of trades you do. There's other things that may influence the kinds of trades you do as well, including implied volatility. So we're going to talk about that here. And then we'll flip on over to some example trades, and then we're going to leave some time to manage some trades towards the end there. But we say implied volatility. What is implied volatility? Let's start with that. We'll start with kind of the basics, and then we'll move on to more advanced stuff. And part of this is born out of some response to you, because in the chat, when we have these surveys and we have these survey links and we ask for feedback, one of the bits of feedback I've gotten was, I've seen this Ivy rank thing. Do you have Ivy rank? What is that? And I want to talk to you about implied volatility measures, including what IV rank is, IV percentiles, and I'm going to share with you a script today. I usually don't like to share scripts or put special scripts in these webcasts, to be honest, because it creates a lot of confusion for people. If they don't have the explanation for them, if they come after, then they're trying to load the script, and it's just more problems than it's worth. But this is one that, for the topic I'm going to talk about today, I think it's an important one. I put the script on my X account at Brentmore CS. If you want that, I think there's a pinned tweet, but right below that, that's the next tweet down. And you can pull that up. But I'll share it with you here in the class too, though. But if you're watching after the fact, today is April 23rd, and you want to get that, you can just look at my X feed there. I'll be sharing that later. But let's start off with implied volatility. Implied volatility is just a measure of how expensive options are. In general, options are more expensive when there's more uncertainty about the market, when there's more expectation for movement in the market. And right now, there's a lot of uncertainty in the market, maybe a little less so right now than there was a week ago, who knows. One common measure that we'll use on implied volatility is the VIX. and you can see that's come down. But you can see this is by historical measures, this is actually a fairly high level. We're up near 30, and I can go back to a longer term chart, and that would probably illustrate that even a little better. Here's a 3-year chart. You can see we're right here. You can see most of the time we're below that. Most of the time, options are cheaper than where we're at right now. And most of the time, there's a little less kind of uncertainty in the market right now. Those two things go hand in hand. But you can measure implied volatility on individual stocks as well. This is VIX is implied volatility on the S&P 500. But if I just want to pull up a stock, we'll just pull up Microsoft as an example, and all the stocks we look at today are example stocks. And I want to pull up that implied volatility. I can go to my little flask up there, type in IMP, put in implied volatility. That'll bring it up right on the chart, and you can see where it is. This is a 6-month chart. You can see where implied volatility is on this particular stock right now as to where it is. And I think that's a beneficial measure, because not only can we see what an implied volatility is, we can see where it's been, and we can see the trend that it's going in. And that's very key for implied volatility, because it's not just the level of implied volatility. It's the implied volatility compared to its own history, in a sense. You know, I could play golf and I could say, hey, Cam, I shot an 85. And Cam may say, well, I don't know how good a golfer you are. That may not be meaningful. And so, but for me, that's great. That's absolutely wonderful, because by my standard, we're going to do the same thing with Microsoft or whatever stock we're doing. Again, this is an example. Okay. So that's what we're going to do. It's compared to its own history. You know, when we talk about trading and options trading, there's kind of 3 biggies that we're going to talk about as to what influences that option price. One is the stock price, the price of the underlying stock. If we do a bearish trade and the stock goes up, it probably doesn't matter much what else happens. We're probably not going to do very well on that trade, are we? Okay, the stock price movements influence that. That's one of the biggies. Time decay. If we buy an option, that time decay is going to work against us. If we sell an option, time decay can help us, everything else being equal. That's the second kind of biggie. And there's going to be others too. But the third one is implied volatility changes. If we have an option that benefits from increases in implied volatility goes up, that tends to help us out. If implied volatility goes down, that would tend to hurt us if it's what we would call a long Vega trade. Vega is just a measure of how that option trade is going to react to changes in implied volatility. Okay? So there we go. Now, there's other things, you know, interest rates can affect it as well, but those are the big 3 that I kind of talk about in here. And today we're going to be focusing on this implied volatility aspect of this. So if our expectation is implied volatility is going to go down, that may influence us to do one trade. If we expect, you know, hey, implied volatility is just going to keep going up, we may have a different expectation. So we're going to kind of do an analysis on both of those things. Okay. And he says, will the chart for IV be IV for the day or for whatever the time period? This is looking at, so this implied volatility here is technically actually an average implied volatility for different options on whatever stock we're looking at here. So those implied volatilities change day to day. They can change within a day, minute to minute, they'll change. So it's looking at the current implied volatility for today, right now. That's what that is. This was looking at the current implied volatility for, you know, March 17th back there on that. Okay, I'm hoping that's making sense there, but that can change throughout the day. That's looking at the current implied volatility of those implied volatilities on those options. If I pull up the stock, pull up those options on it, what I can do is I can look at those and I can add a column for implied volatility on here. Here's an implied volatility column that I could see. So when I talk about averages, we're looking at averages there. Also, what's this over here? This is the average implied volatility for that particular month. You can see they change from month to month. So if you really want to get to the individual contract, you can bring up a column here for implied volatility. If you want to look at the monthly contract, you can look right there. And this, but on the chart, the benefit of the chart is it kind of gives you the perspective of the history of where it's been and perhaps where it's going. Okay, now I want to talk about some measures here, and this is where that IV percentile measure comes in. If I go to our example stock here, and I look at today's options statistics down here, I can see implied volatility. There's my implied volatility. Again, this is an average implied volatility. But you'll also see, over the last year, 52 weeks, what the high implied volatility is, 52%, what the low implied volatility is, and it'll give us the current IV percentile. What this is a measure is, it's the percentage of time over the last 52 weeks that it's below the current, implied volatilities have been below the current level. Okay? It's the percentage of time over the last 52 weeks that implied volatilities have been below the current level. So if our implied volatility, and this is kind of mid-range, right? About half the time. So if we take where we're at right now and we say, well, half the time it's been above it and half the time it's been below it, then that's going to be about what we're at there. That's what implied volatility percentile tells us. So that's a measure. That's a way of doing it. So if I'm looking for something with a high implied volatility, then I may consider a script for it. And that alternative that sometimes I get asked about is the IV rank. Okay, IV rank. And IV rank, again, is looking at the last 52 weeks, and it's not looking at the percentage of time above or below it. It's where it is compared to the range, compared to the high range, the high level, and compared to the low level. So if you have a high level at, say, 60 and a low level at 20, that's a 40-point range. And if the current level were, say, at 30, well, in that 40-point range in there, we're at about the 25th percentile of that. Okay? There's about the 25th percentile on that. Okay? That's what IV rank would be. I don't actually have an IV rank, but I do have a script to help you with this. Let me show you what that is. Let me go to let me go over here. I'm going to just look at this script. Here's the S&P 100 stocks. And I'm going to pull up, this one is called the IV range. IV range. I shared this script in my X account, on my X account today, if you want it, okay? And if you get that script, you just copy the script, you go up to the gear, you go open shared items, you paste it right in here, you click on preview, and then it may ask you to name it. You can name it whatever you want, and then you import that script, and then it will show whatever, depending on what you named it, right in here. What this is doing is this one is actually only going back 3 months. Now you can change that if you want, but if you want to make it a year, you can make it a year. But let me just kind of show you this script here. And so I'm going to click on customize. We're going to go to this, and let me just bring up this script here. Okay, so here's a script, this IV range script. And this script, by the way, just to give due credit, was created originally by one of our colleagues, Mr. Ken Rose. I know a lot of you know Ken. Ken's doing very well. Last I checked with Ken, by the way, for those of you who are aware. And this is, I tweaked the script just a little bit because he had some extra stuff on there that I felt was a little bit confusing without the explanation. And I didn't want to deal with that. I just want a simple script that you can use. So I took some stuff off. This is looking at 3 months, okay? So that is 63 days. If I wanted to adjust this to a year, I can do that. You would just change that 3 months. You would just change this number right here, basically 21 days in a trading month. Okay, so 63 days, that's a month. 252 days is the approximate time for a trading year if you want to make this a year. You could do that. Okay? All right, and then you can just do that. You can rename it and you could save it. I'm not going to change that right now because I just want to go back over the last 3 months. But this is essentially that IV rank, except it's changing. Instead of looking at the last year, it's looking at the last three months. Okay? If you have any questions on there, so remember, there's about 20, this is going back 20, there's about 21 trading days in a month, right? To take out holidays, take out weekends, every weekend, okay? So that's where we come. It's not going to always be exactly that because not every month has the same number of days, right? So there we go. So let's do this. Now, here we go. I'm loading this. This is saying, hey, compared to where it's been, here's Microsoft. This is about mid-range compared to where Microsoft has been. Let's do this. I don't want to spend too much time on this because I want to get to trading and stuff. Look, we were just above, I think this is like 52. Okay, 52 has been the high IV. Oh, that's over the last 6 months. We need to go to the last 3 months to match our script here. You can use whatever time frame you want. That's at 52. Our low was, what is that, about 21? Okay. 52 high, 21 low. That gives me a range of 31 points, I think. Where are we right now? We're at about 35 right now. In other words, we're 14 points above here. 14 points divided by 31 is going to give us approximately our 47 there. Okay? You got that? So that's how that comes up. So this tells us where we are in relation to where we've been. Now, if you don't want to deal with this script, don't worry about it. I don't usually use this, to be honest, but I've been asked for it, which is why I'm sharing it to you. That I've been asked for it. What do I normally do? Normally, I just use this and I look at where it is compared to where it's been, and then I kind of look, well, what's happening lately? It's been trending down lately. So I actually prefer this, but I get so many questions on the other, and that's why I've shared that script with you. Okay? So, any questions on that? Let me know. Let me know. But here's the point, okay? And, oh, by the way, Terry brought up something. The percentile rank is about 53% over the last year. More often not, that IV percentile and the IV rank or IV range is going to be pretty close to one another. You know, not always, but again, I actually like using this. So you don't even need the script if you don't want it, but some people like that, okay? Some people are big fans of scripts there. Okay, so let me just wrap up the IV discussion and let's do some trades here. Implied volatility is not about where it's been, it's about what we think it's going to do. But if implied volatilities are high, that means if you're selling an option, you're getting more premium in. Okay. Now, it's not a free lunch. We don't just aren't going to blindly buy or do option trades and sell options on high IV stocks because, look, they're high for a reason. They're high because there's potentially more movement on them, more uncertainty on them. That's why they're high. But in general, sellers like high IVs that they think are going to go down. Okay? Sellers like, I'm going to repeat that because I think it's important. In general, sellers of option strategies like high IVs that they expect to be going down. It doesn't do you any good to sell a high IV if that IV is just going to go higher. Okay, buyers of options tend to like implied volatilities that are low that they expect are going to rise. Buyers of options tend to like IVs that are low because they can buy for cheaper that they expect to rise. That means their vega is going to help you out on that. Now, any option trade may be long vega. In other words, benefit from increases in implied volatility or short vega. Short vega trades would be selling options, selling a call. We don't usually sell naked calls, but selling a put. Okay. Often instead of selling naked calls for risk protection, people will do a spread trade. They'll sell a call vertical. Anytime you do a vertical, okay, anytime you do a vertical spread, you have a long option and a short option, okay? They're going to largely offset each other. They're going to largely offset each other, okay? So just be aware. The biggest implied volatility effects you're going to have are on single options typically. Just a single long option, single short option, or something like that. Those are going to be the biggest implied volatility. Once you start adding other legs into there, that changes things. So I said short options are going to be negative vega. They tend to benefit from drops in implied volatility. Things like butterflies are going to be negative vega. And if you want more on butterflies, I did a demonstration on butterflies in last week's advanced options webcast that I teach. Okay. So short verticals, butterflies would be another one. Iron condors, of course, would be another short vega. What about long vega trades? Well, long options would be long vega. So this would be positive vega. This would be negative vega. Positive vega trades, long options, long single options. Things like a calendar spread would be positive vega. We talk about this in this class quite a bit. So, but I wanted to give you the measures today on this. So here's the premise that I'm going to go off of. I'm going to use this right here. I'm going to use our IV rank here, our IV range, I guess is what the script is called. And I'm going to look for things that have a higher implied volatility range. I'm going to look for things on the higher end of this spectrum here, okay? Well, we can see where they are. Now you may be going, well, look, they're actually not that high. Well, consider they spiked pretty high, what we just went through over the last 3 months. So most are off their highs on that, okay? Most stocks are off their highs on that. But as you go down the list, you can see, well, mid-range, let me go halfway. Mid-range is around the 40, 30, high 30s range there, okay? So there we go. I'm going to try and go, we'll say stick with something like 50 or above or somewhere in there, okay? So let's do a trade or two, okay? So let's do I'm going to look at UPS here as an example trade. The general trend has been down on UPS, okay? The general trend has been down, and the implied volatility is relatively high compared to where it's been, okay? But it's actually been declining a little bit. Now, some of you are going to be saying, yes, there is earnings coming out. I'm not going to take the time to go to the earnings calendar right now, folks. There's a lot of earnings coming. Almost every stock has earnings in the next like 3 or 4 weeks, it seems like. So I'm not going to, now earnings adds more volatility to the mix, but it also, what we expect is after earnings, typically implied volatilities tend to drop more. So that, or implied volatility would only help with earnings. Now the stock price, it may not help our stock price here. But what I'm going to say is, I have some potential resistance around that 100 range, nice round number, 20-day moving average right there. We've kind of bounced off that before. I'm going to do a short call vertical on that. Short call verticals is a trade where we would tend to benefit from those negative implied volatilities. Okay? All right. Now, let's do that, but let me just hit a question up. Josh says, good question, Josh. Should we think or use the implied volatility study as a mean reverting tool? Okay. And what does Josh mean by that? It means when implied volatilities spike up like this, typically they tend to come back to normal. Or perhaps if they go down, that hasn't been the problem lately for the most part. But if they were to go down to an extreme level, or do we expect them to go back to more of a mean? And I would probably agree with that, Josh. Yes. Right now, if we look at implied volatilities, little generalization here, are going to be high. Expectation is over time they may come down. Now, that's an expectation. That's not a guarantee. The more there's uncertainty in the market, the longer that implied volatility can remain high. Okay. Now, remember, implied volatility isn't the only thing that's going to, affect the trade. Implied volatility may go our way, but if we do a bearish trade and the stock goes way up, that's not going to help us. But I'm going to call my resistance at 100, and I'm going to do a trade accordingly here on that. So I'm going to go to UPS. I'll go out monthly contracts, okay? And I'm going to go to, let me get some more strikes here. And I'm going to use just use delta for us here. And I'm going to use delta. Delta measures how much that stock price. Why will this not let me adjust my column width here? Oh, let me get rid of that. That's why. Well, I don't need to adjust it. Now it shows. Okay. I'm going to use my calls. Look at the calls. Delta tells us how much the option is going to move in relationship to a move in the underlying stock price. It also can be used to kind of gauge the likelihood of it going in the money. I'm going to go out to about a 35 delta here. I'm going to go about to 102. That's above our resistance level. I'm going to sell that contract. I'm going to click on the bid price. And I'll go above that. I'm going to hit down Control key. Here is a short option. Now, short call. Now, if I go to the 104 instead, that's actually going to probably benefit me to the extent that if I look at my Vegas on those, there's probably a little bigger difference between, this is rounded to 2 points, but if I were to increase the number of digits on this, the bigger the gap, probably the bigger the difference in your Vega. But there's an important purpose to this. Point. If I'm selling a contract, say I'm selling this 100, that would just be a negative Vega of 10. But if I'm buying one, this is adding positive Vega in there, and I'm actually only getting the net Vega in there. So it's not that big a difference there. Not that big a difference there. Okay, so it's not probably the biggest factor in the trade. In this case, we need to be bearish on this trade. Okay, so here's what I'm going to do. I'm going to enter this order, and I'm just going to put this in. I'm going to confirm and send, and I'm actually going to do, we'll do 3 contracts on that. That's giving us max loss of around $400. That's the theoretical max loss. Remember, short options can be assigned early. Okay, let's do this. And I'm going to add in a short vertical into the mix there. Okay, so we just added that in there. Okay. I want to do another quickie here, and then I want to get to trade management. Okay, so on this one, what I'm going to do is I'm going to go back to our list. I want something, again, I said about 50-ish or higher. And I want something where I think implied volatilities are going down. I'm going to take something where I'm going to do a different type of trade here. Here's Target. Target has generally been trending down, target's been beaten up big time. And I want to do a different type trade. I'm going to go something a little bit more neutral, but slightly bearish here. I'm going to say potential support here. We hit a few times off that, but generally going down. Implied volatilities are going down. So what I'm going to do is I'm going to do another trade that is a negative vega trade, and it's one I mentioned, I taught last week. In fact, Cam put that link in the class for us, called on long butterflies. Okay, so let's do a butterfly here, and but I'm gonna target down a little bit below where we're at. Okay, so I'm gonna go here. I'll go to my monthly contracts again, and I'm going to go to 90. I'm going to sell, well, let me do this. I'm going to change spread to butterfly. I'm going to go 90 as my middle strike. That's my target price on a butterfly. That's my target price. And then I'll tweak my width after I do this, though. But I'm just going to click on this initially. Okay. Now, here we go. How wide are we going to put these? We're going to put these as wide as we think is the likely range is going to be. Now, what I can do is I can go here and I can say, well, let's use our delta. Let's go back to our delta again on this. And let me go to single. And I'm going to go here. What are my odds of this going down to a lower level? Like, let's try, let me just get a couple more strikes here on this. Do 20. Going all the way down to 84, about a 20 delta. So I'm going to try an 84. That's about a 20%, 21% chance of it being in the money. And whenever we use these, they're just approximations. We don't know exactly what it's going to be. So I'm going to go to a, what do we say, 84. So let me go back to my trade tab. Actually, I'm on my trade tab. Let me go back to my trade. I'm going to do this, and I go down to about 84 there. And I'm going to make this an equidistant. So we're going to go to 96, 96, 6 points on either side. And that is a butterfly spread. If I want to look at what this is going to look like, let me click on Analyze Trade. This is what it looks like. This is our max gain theoretically on this trade, gain of about $450. The odds of hitting that exactly, probably pretty slim. Probably pretty slim we're going to hit that exactly. So we're not going to insist on it getting up to, you know, a $450 profit on this. If we get halfway there, we're probably in good shape. If we get over, well, we'll say $400 or $225 would be half of our max profit. We could possibly get out at that point. Okay. Here's our max loss. Our max loss is about $129 on that trade. Okay. Now, the challenge is this. This is not a high probability trade. So butterflies aren't high probability trades, but it is a trade where we're a little bearish. The stock is right here on this chart. The stock this is the current price of the stock right there on this. So we're looking for it to go down a little bit. That's where we're going to profit. Hopefully, if it goes down, we can hit our loss on that, our expected gain on that, which is about right there, $225. That's what we want. Okay, let's go back here and let's do that trade, because I want to get to trade management here in just a minute. But I'm going to actually put on an exit order on this. I'm going to do a first triggers OCO. I'm going to right click. I'm going to create an opposite order. Okay. And I have two exits on this. On this one, we're getting in for a price of approximately 129, 130. What would represent that gain, our target gain? We said $225. So I'd add $225 to my initial debit, which would make this about $350 $300 would be our target on that. Yeah, $350 would be our target. That's an initial debit. I want to sell it for, that's a limit for $350. Okay. And hold on, that is, why is that showing? That's my debit. I did it wrong, folks. I did it wrong. Well, we have $132 minus the $225. That's going to be about $93. If we can get out at a 93 credit on that, that's going to be our gain on that. What about a loss? So we're going to put in a stop here on this as well. And our stop is if we're buying at 155. Sorry, I just got a little. Sorry, I didn't. I did that right originally in the first place. I don't know why that's showing as a credit. I did that right originally. 225 plus 145 is 370. 3.70 is going to be our target on that. And our stop, I'm going to put it 50%. So I'm going to put at half of our initial debit of 162. Okay. Half of 130 is about 0.65. 0.65. Okay. There we go. And those are going to be good till canceled. Good till canceled. Okay. And I will share that script by the way. Okay. I will share that script. I see some of you talking in the chat. I did put in my X too, my X account as well there on that. Okay. So there's my trade. There's my stop. If it goes south on us, here's my limit. If it goes well on this, I'm going to confirm and send. I'm going to make this, I'm going to put this in my butterflies category. We're going to send that trade there. Okay. And that has not filled. We'll wait and see if that fills on that. Now I want to get to some measures there, some management of trades. But before I do so, let me share that script before I forget. Customize. Let me just click here. I'm going to share IV range. Okay. Share. And I'll put that. And just remember, scripts are not guaranteed for timing or accuracy there on those. So hopefully it's a convenience for you. Like I mentioned before, I often find just looking at this is beneficial to me on that. Okay. And there's our target trade on that. Okay. But I want to go through some management here before I run out of time. Number one, remember, we talk about this each week. When we talk about exiting, have an exit, consider your exits if things are going well. Consider your exits if they're going poorly, and consider your exits if they're just kind of going okay. Nike in this case is going okay. We're up about $26 on this. We're under 10 days to go till expiration. You don't need to get out at 9 days to expiration, but typically in this class, we teach getting out with about a week or so till expiration. And so what I'm going to do is I'm going to manage this trade and we're going to exit this trade. It's a small profit, but we'll take a small profit here on this, in this example trade here. So what I'm going to do here is I'm actually going to cancel my exit orders. Okay. I'm going to cancel those stops and everything. And I'm going to look to exit this short vertical right now because we're not near our max gain. We're not losing a lot of money either, but we're under 10 days to go till expiration. So we're going to get out there. So we're going to create a closing order. And it's coming up in my other screen here. But I'm going to put this in and I'm going to Just see if we can make sure we get filled on that. Confirm and send, and I'm going to send that order, and I'm going to get out. Okay? So there we go. Let's look at another one. Okay, let's go. Here's what I want to do. I want to go to UNP, and I want to show you something that I looked at earlier. Here's Union Pacific, and this is what trade we rolled. It was, I think, a couple weeks ago we rolled this. We took in a whole, a nice credit when we rolled it. But since we've rolled it, it's gone south. And I looked at this earlier and I saw, I don't have a stop on this, but I could have sworn I put a stop in. Well, let me show you what sometimes happens on Thinkorswim. Sometimes your order gets disassociated with the trade. Okay, so look at UNP. Here, it's showing, it doesn't show the quantity. Here shows the quantity, but there's no stop showing. Here we have the stop, but there's no quantity. How do you fix that? How you fix that is, I'm going to unallocate this, right? So I'm going to right click on it. I'm going to move to group. I'm going to go to unallocated. Now these are rejoined. There's a reunion, a Union Pacific reunion here of my stop order and my actual trade. Now what I can do is I can go and I can move back to my long single options group. That didn't work. Oh, I did the wrong thing. Hold on. Boy, today's a rough one here. Okay. Let me move this back to the group. I clicked on the wrong thing. Okay. Click on the whole shebang. Click on UNP up here. Now, if you move it to the group, I think, yes, it brought them both back together here. So we're all happy again. Now, what about this? What's our stop? This has been losing money since we rolled this. What's our stop condition on this? Our stop condition is if it goes above $225. Well, how close are we? UNP. $225 is right about where my cursor is. We barely missed that today getting stopped out. Okay, so it almost stopped out. It didn't quite do that. I'm just going to stick with that and let that sit because we've got a valid stop there on that trade here. Okay, hoping that's making sense. One other. Let's look at one other, perhaps, and then we'll probably have to call it good. Okay, I have on NVIDIA. What's NVIDIA? This is a long iron condor. Okay, long iron condor. Kind of the strange thing is when you're talking about short iron condors, although it is possible, typically you're going to win on one end and lose on the other end. Because on a short iron condor, if it goes up, you win on the end that's the put side. If it goes down, you win on the call side. In this case, what I have is I have a long iron condor, and look at my strikes here. And I'm going to have to wrap up here with this one there. Look at my strikes. My long strikes are 110 and 90. This is a long iron condor, meaning we want this to move a lot. Okay? NVDA. So we did this back here, and we want it to either go below 90 or above 110. What has it done? It's gone up and down, but we're basically where we started. Okay? Okay? We're basically where we started on this trade. So that's not what we wanted to have happen. So we're going to get out of this trade here, and we're going to take our lumps here. We lost a little money on this one, but I'm going to create a closing order on this. I'm going to move this out, send this. I'm going to get out 1/2 of the trade at a time, just for pricing purposes. Usually that is beneficial. Right click. I'm going to create that closing order, and I'm going to get out of this. And I think we're going to call that a day here, folks. Thank you so much for joining me today. Coming up next, we have trading price patterns. So make sure you check that out. Appreciate you. Yeah, Wiley says, do a long iron condor before you could. That'd be a trade based on a big movement. No doubt you can do that. Cam, thank you for helping me out in the chat today. And I think we got through what we accomplished. We were hoping to talk about implied volatility, some of these implied volatility measures, such as implied volatility percentiles, implied volatility ranges. Again, you can check our X accounts at Cameron May CS, at Brent Moore CS. And I posted that link there for that IV range column if you're interested in that. Everybody, have a wonderful rest of the day. We'll see you same time next week. Bye-bye, everybody.